वेलकम टू वीलर्न। वीलर्न में आपका स्वागत है। Topic for today's discussion is mergers and acquisition, and we would be covering session 12, demergers. Topics covered are introduction, meaning of demerger, characteristics of demerger, structure of demerger, spin-off, split-off, split-up, tax implication of demerger, and demerger under Income Tax Act. In this unit, we will be studying various key characteristics and structure of demerger. Also, a demerger results in the transfer by a company of one or more undertakings to another company. The example of TCI demerger, where it's a real estate and warehousing division and it's being demerged into a new company by name of TCI Developer Limited, TDL. When we say demergers, what is the meaning of demerger? There are large entities who sometimes, because of the hinder entrepreneurial initiatives or sideline to the core business activities, or there is some reduction in the accountability and to promote investment in non-core activities. So, since there is an increasing realization among companies that demerger allows them to strengthen their core competence and realize their true value of the business. Demerger is often described as a division or separation of different undertakings of a business functioning hitherto under a common corporate umbrella. A scheme of demerger is in effect a corporate positioning or partition of a company into two separate distinctive undertakings, thereby retaining one undertaking with it and transferring the other undertaking to the resulting company. Such a split or division, it may take place for various reasons. For example, a conglomerate company carrying out various activities might transfer one or more of its existing activities to a new company for carrying out rationalization or embarking specialization in the manufacturing process. Also, what happened? Such a transfer might be of a less successful part of the undertaking to a newly formed company. Section Companies Act 1956, it has not defined demerger. However, it has been defined in the subsection 19AA of Section 2 of the Income Tax Act 1961. According to this subsection, demerger in relation to company, it means transfer pursuant of scheme of arrangement under Section 391 to 394 of the Companies Act 1956 by a demerged company of its one or more undertakings to any resulting company in such a manner that all the property of the undertaking is being transferred by the demerged company immediately before the demerger becomes the property of the resulting company. Also, the liabilities relatable to the undertaking, they are being transferred by the demerged company immediately before the demerger. It also becomes the liability of the resulting company. Now, there are certain characteristics of demerger, and it is basically a scheme of arrangement, and it is done by approval of majority of shareholders holding share representing 3/4 value in meeting convened for the purpose, or by the approval or the sanction of the High Court. Secondly, demerger also involves transfer of one or more undertaking. The third characteristic is the transfer of undertaking is by the demerged company, which is otherwise known as transferor company. Here the company to which the undertaking is transferred is known as the resulting company, which is otherwise known as transferee company. When we discuss about the structure of demerger, so corporate demerger among all other ways is one of the ways through which a company decides to divest its abilities and interest and tries to focus or improve on one or major areas. A demerger is a kind of pro rata distribution of the shares of the firm's subsidiary to the shareholder of the firms. There is neither a dilution of equity nor a transfer of ownership from the current shareholder. After the distribution, the operations and management of the subsidiary, they are separated from those of the parents. Demerger, it constitutes a unique mode of divesting assets since they do not involve any transaction. They can also not be motivated by a desire to generate cash to pay off their debts, as is often the case with other modes of divestitures. Now, there are various ways in which a demerger can be done. The first one is the spin-off, the second one is split-off, and the third one is split-up. When we say spin-off, so spin-off is a situation wherein the company decides to get rid of all those kinds of entities or business which are underperforming or which are not performing up to the standards, which are dragging their profits down, dragging the profits of the entire corporate entity. So in such a scenario where one or two business division, they are not core business units and which are pulling the profits down, the company decides to get rid of such unperforming or underperforming units. Now there is a process of spin-off. When we say process, here the company first decides to spin off a business division. So the first step in a spin-off process is to decide about which business divisions are to be spinned off. The second is the parent company, the core business company, it files the necessary paperwork to SEBI. Because until those paperwork are submitted to SEBI, the next step could not be followed. The third is the spin-off, it becomes a company of its own and must also file the paperwork with the SEBI. When that underperforming or non-performing company is being separated from the core business division, then it in itself becomes an independent entity. And when it becomes an independent entity, it is also then required to do all the paperwork and subsequently submit that paper to the SEBI. Furthermore, this new constituted company or independent entity, the shares in these companies, they are required to be distributed to parent company shareholders. Lastly, the spin-off company, the company which has been got ridden off by the parent company, it goes public. Now, what happens? There are two reasons how this creates a value, how spinning off, getting rid of underperforming company and diluting the activities from the core business, how it affects and it creates value. The first value creation it does is the parent company shareholders, they rarely want anything to do with the new spin-off. So since they become two separate entity, the shareholders of the parent company, they have nothing to do, they are independent of the spin-off company. So since it is an underperforming division that was cut off to improve the bottom lines, so as a new result there are many new shareholders who sell immediately after the company goes public. The second is large institutions, they are often forbidden to hold shares in spin-off due to the smaller market capitalization or increased risk of poor financials of the new company. So it is very essential that many large institutions, they automatically sell their shares immediately after the new company goes public. Now when we talk about features of spin-off, so there are certain inherent features of spin-off when we discuss. The very first feature is there is no cash exchange. So when an underperforming company is got ridden off by the parent company, there is no cash transaction, no cash which is being exchanged. Second is subsidiaries' assets are not revalued. The third is the transactions are treated stock dividend and a tax-free exchange. So whatever transactions are done during the spinning off, they are treated as stock dividend and they are free from tax. The fourth is the existing shareholders, they have the same proportion of ownership in the new entity as in the original firm. So the ownership of the shareholders, that does not get diluted, it remains the same, only the name does change, and it is called as proportion of ownership. Another is separation of controls. Since an underperforming company or a business unit, it has been spinned off, it has been got ridden off, now there is separation of control. It is now not being controlled by the parent company. The new entity exists as a separate decision-making unit, independent of the parent unit. Now the parent unit does not have any control whatsoever to the new entity which is now being created. Lastly, when we say it may also develop policies and strategies which are different from the original parent company. Since it has become an independent unit, the policies, the strategies can also differ. When we talk about split-offs, so split-off is a situation where it is a transaction in which not all, but the parent company shareholder, they receive shares in subsidiary. And how they receive the share in the subsidiary? In return of relinquishing their parent company shares. So it's a case of exchange of shares of parent companies. So in other words, we can say some parent company shareholders, they receive the subsidiary shares in return for which they must give up their parent's company shares. When we talk about the features, it's exactly the same. A split off happens when the existing shareholders, they get their stock exchanged in subsidiary company for parent company stock. Another situation is a split up. So a split up situation is a situation where a company is split, is divided into two or more independent companies or entities. As a result, the company, entire corporate entity, it disappears as a corporate entity, and in its place there are two or more separate companies which emerges, right? In another word, here a transaction in which a company spins off all its subsidiaries to its shareholders and ceases to exist. The features are the entire firm is broken up into various spin-off. The parent company is no longer existent, and only the new companies they are there who survive. Now when we talk about the tax implications of demerger, so the business and economic environment of any country, they have enhanced the need for rationalization of laws relating to business organization or reorganization, restructuring of production system, and better utilization of resources. So this has become very, very necessary with a view to enable the Indian industry to rearrange itself to become globally competitive. So in order to incorporate the recent structural amendments, new provisions which are relating to demergers of companies, they were introduced in 2000 by Finance Act 1991. These amendments which were introduced, they enabled corporate bodies to ensure that the demerger should be taxed neutral and should not attract any additional liability of tax. Second is the demerger, the tax benefits and concessions available to any undertaking should be available to the said undertaking on its transfer to the resulting company. The tax benefit to such business organization should be limited to the transfer of business as a going concern and not to the transfer of the specific assets. The accumulated losses of a demerger should be allowed to be carried forward by the resulting company if these are directly relatable to the undertaking. So such losses and depreciation, they should be apportioned between the demerged company and the resulting company in the reasonable manner. Also, it is to be taken that there is the tax relief in a resulting company, that the resulting company is an Indian company. So when we say demerger under Income Tax Act, so there are certain provisions that needs to be taken care of. There are certain conditions for a transaction to be recognized as a demerger. So first is that all the assets and liabilities, they are transferred from the demerged company to the resulting company. Once the resulting company, the company has demerged, so the assets and liabilities, they also get transferred. The second is the transfer is effected on a going concern basis and it is at the book value. The third is neither the company nor their shareholders, they are now, after the demerger, they are not subject to capital gains tax. Tax benefits and concessions which are available to any undertaking, they should be available to the said undertaking on its transfer to the resulting company. Furthermore, any accumulated losses or any kind of unabsorbed depreciation, it would also get carried forward to the resulting company. Another is the expenses which are incurred for the purpose of demerger. They are allowed as deductions in 5 equal installment of 20% each. When we also say that the shareholding which is not less than 75% in the value of share in the demerged company, it becomes the shareholder of the resulting company by virtue of demerger. Furthermore, if we discuss that in consideration of the demerger, the resulting company issue its shares to the shareholder of the demerged company on a proportionate basis. So when a transaction satisfies the above condition, the following tax provisions are applicable. So there are two exercises. One is what are the structures of demerger and what is the meaning of demerger and what are the various characteristics of demerger. Thank you and have a nice day. Keep learning and relearning.